For professional advice with a personal touch, consult FL Fuller Landau, Chartered Professional Accountants and Business Advisors. Click on flmontreal.com.
Welcome to today's Entrepreneur, presented by FL Montreal, a program about the entrepreneurial spirit that drives Quebec business. My name is Dan Delmar, along with FL Montreal's Josh Miller. Good evening, Josh.
Hello, Dan.
And nice to have you back after a
Good
week
to be
of,
back.
Traveling and recuperating. Tonight we usually do a bit of a chat at the beginning on entrepreneurial stories, but we have one big story that we're going to get to in just a second. This evening on the program, we're going to talk about spas and beauty with Victor and Richard from Intercouple Spa, popular business around the Décarie area. And later in the show, we'll be speaking with Micheline Mayette, HR consultant on culture and conflict resolution in the workplace. But first, as you know, Josh, of course, we've been following the story very closely over the last few weeks. This is the big tax changes coming for entrepreneurs. The federal Liberal government says it will lower small business tax rates to 10% in January and 9% in 2019. This is an effort to I suppose, stem some of the or avoid some of the criticism after these small business tax changes. The small business tax rate currently at 10.5%. So again, dropping to 10% in January and then 9% in 2019. And joining us in studio now is Nick Moraitis, tax partner at FL. Josh, Nick, your thoughts on the government move here?
Well, there's no question that there was some backpedaling. There's no question that when they came out July 18th, the onslaught of commentary, scathing commentary from so many different associations, organizations, entrepreneurs, certainly made them think a little bit and came back with some adjustments to their proposals, but not completely. So we'll turn to Nick and we'll get right into the meat of it, at least some of it. And Nick, I guess that there's a few areas that they've slightly adjusted their thinking on. So let's kind of hit them one at a time. There's no question, Dan just started talking about the reduction in the small business rate. That's something that's kind of new when they came out to it with it. Maybe we can start there.
It looks like they backpedaled a bit. There was no discussion of reducing the small business tax rate. Now they're saying, well, we weren't going to do it until we looked at everything else about private corporations. So, Dan, you're right. It goes to 10% January 1st, 2018, and falls to 9% the year later, January 1st, 2019. So a business here in Quebec is going to be looking to pay 18% as of next year, and if my math is correct, 17% the year after. However, in Quebec, if you don't have more than, it works out to about 3 employees, you will be paying a higher rate. So it's really a proposal that's supposed to help small businesses grow, gives them extra cash to pay down debt, buy equipment, hire employees. But what this seems to be going is that there were several proposals they came at, the government came at. So this is a little bit of a gimme. So the average Canadian private corporation business, according to the government documents here, earns about $100,000 worth of profit pre-tax. So if they're saving at 1.5%, eventually it'll be about $1,500 worth of annual tax savings.
I guess they're going back to their original platform. You know, that there was supposed to be reduction in rates over time, so they're kind of bringing it in almost after the fact.
That's right, and they're trying to appease, I guess, the smaller businesses, because there is, those businesses usually are the ones that are undercapitalized. They're like, we've had people on the show where you had to borrow from family and friends to get into the business, etc. So that's what these lower tax rates are designed to do.
So in addition to the lower tax rates, which is a bit of news today, then there's also the other items, some of the other proposed changes that they're adjusting, they're modifying. Again, let's touch on them one at a time. Income sprinkling.
So there was income sprinkling, the lifetime capital gains exemption, converting income into capital gains, and then the discussion regarding investment income earned by Canadian private corporations. So on the income splitting, they're still maintaining the principle that we want to limit the amount of income that can be paid to family members. But now what they seem to be saying is what was verbally said, and I can't quite find it in the written documents, is if the family member is not at all involved in the business, then any monies paid to them will be taxed at the top tax rate, regardless if it's $1 or $1 million. It doesn't matter. So that's automatically top rate. What isn't clear is what happens if you are working in the business, and then to what degree. And the current rules that came out with the proposed rules made it very, very difficult. And the scary part was, as we were talking to people, is if you started a business when you were a young man, like our guest tonight, who's been in business for 40 years, and if you decide today I want to retire, take it easy, and my children are taking over, well, technically, according to the rules, you've just went from being a good shareholder who can get whatever you want from the company to being a bad shareholder. You shouldn't be getting paid anything for it unless you work for it, and yet you started the business. And that's how the rules were so complicated. So we're hoping to see them narrow down the definition, make it a lot simpler, and make it a lot less of a challenge between the business owner and the Canada Revenue Agency in terms of discussing things.
How does the Revenue Canada establish who's really quote unquote working at the business, who's part time? I mean, it seems hard to police that kind of thing.
Well, there's aside from asking the receptionist, show me where Mr. and Mrs. Spouses and all that. But if the family is in there, I mean, you can usually, if they're a director, you'll know. If they're a signing authority, you know. If the child is doing something in the business, they can see. They can determine job descriptions, emails, etc. That becomes difficult. Where it becomes really difficult, though, is, Dan, I can determine what you do in your work. How much are you worth? So if I think you're worth a lot less than what you think you are worth, we're into a battle. So you're going to be asking a judge to make that decision. So that's the income sprinkling.
Yeah, and there's no question that it's going to be a question of fact, but there's going to be a lot of gray zone.
That's
so
right.
Let's go to capital
gains exemption. Well, if I understand this correctly, they're backing off on the limitation of the capital gains exemption. The original proposal said, well, the only capital gain exemption we think is justifiable is to the founder, to the CEO, the man or the woman running the business. Everybody else in the family, unless you're also very important in the family, do not deserve getting the capital gains exemption. And if you try to get it, we will tax you in an inordinate manner. Which led to many cases double tax. They seem to have been backing off because there been a lot of unintended consequences by saying that. If a shareholder is not going to get a capital gain and get a capital gains exemption, is going to be taxed as something else. There's a lot of things that can happen to a shareholder.
What about the structures that exist today where you have that 15-year-old as a shareholder?
Well,
it's going to be 18 eventually.
That we don't know. There'll be more information coming out this week, we hear. So far has been what we heard on the news conference that came out around noon today, and some brief documentation in here. The other item was capital gains and converting. They seem to have recognized that there's a lot of unintended consequences with what they wrote. So they may be looking at it to avoid double taxation, which is inherent in what they wrote, and what I call retroactive taxation as well. The fact that they couldn't figure this out before writing it, and we pay a lot of people to be very smart in finance and justice, scares me as a taxpayer that they didn't think this through and they waited for us. The other area which they haven't spoken to, but I'm thinking that, and the way they mentioned the decrease in the small business rate is the taxation of investment income in private corporations. So what they're still not happy about is that if you did now pay, as I said, in 2 years' time, here in Quebec will be a 17% tax rate. That's 83 cents left over to do something. If you don't want to invest it in your business, or if your business doesn't need the money, then fine. You're going to pay it into a holding company and use that money to invest in the stock market, to invest in real estate, to do something else, which they're not interested in letting you have those 83 cents. What is going to happen there, we're not sure yet. I know they came up with ideas in July 18. They didn't discuss it on this time around, but I'm getting the feeling that they keep saying that we're reducing the rate to help businesses grow, create jobs. We're not reducing the rate so you can store more cash in your holding company for your retirement. So there's going to be more fun coming.
But that question of intent is also a big gray zone, and I'm sure there's going to be a lot of commentary and backlash from that one.
All right, we'll continue to follow this as we go along. And coming up next, our profile for the evening, Victor, Susanna, and Richard Zilber of Intercouple Spa.